Let's deep dive into this matter also. We've got our experts who are connected. Sanjay, Senior Partner, Crawford Pele and Company. We also have Shailesh Haribhakti, Chairman, Shailesh Haribhakti Associates. And we also have Rudramurthy, BV, MD, Vachana Investments. Hi, afternoon and welcome to the show. Let's understand the legal standpoint first. And Mr. Haribhakti, I'll come to you. How does this qualify as a routine regulatory action? Or is it an exceptional step? How can we look at it? There has been repeated instances, if we can just call that repeated instances of manipulating the prices, artificially influencing the markets as well. How do you read between the lines over here?
Well, what SEBI is doing is guarding the integrity of our capital markets. The conduct of Jane Street seems to indicate that they have used through multiple entities and through multiple markets the arbitrage opportunities and actually manipulated indexes and prices in a way that will derive for them profits in one market 12 times the loss that they would incur in another. And they did this consistently and despite a warning letter. And that seems to be the egregious behavior which has brought about SEBI's the complete stoppage of Jane Street's activities in our capital markets, as well as a depositing of 4,800 odd crores of rupees as an interim order to impound all of those illegal gains that they have made.
All right, I want to come to Mr. Rudramurthy. Since you are a market participant, you will understand this better, and I want you to explain to our viewers what exactly happened, which kind of strategy was adopted, whereby on one hand, there was a position which was built on the cash side, future side, but on the option side, a definite kind of position was built, and specifically on 17th of January, which is in question, the firm made 735 crore due to it. Mr. Rudramurthy, how this is operated?
Good afternoon, Ankur. The secretive strategy, the name used is secretive strategy of so-called Jane Street. What they have done is very, very simple. They have used the leverage benefit what you get in options versus what is there available in futures. Very simple. You just go and buy future stocks. For example, if you buy HDFC Bank and ICICI Bank on the long side, these two stocks have more than 50% weightage on your Bank Nifty. So by buying both HDFC Bank and ICICI Bank, you will have Bank Nifty also slowly moving up. And then what they do is they buy put options. Actually, they have made money out of option trade and they have in fact lost money out of future trade, but the money gained out of option trade is close to that 12-13 times more than what they have lost in futures. So by buying into stocks like, let us say, ICICI Bank and HDFC Bank, you take the market that is Bank Nifty higher and then you buy put options as well as sell call option. So by buying put options which are available at a throwaway price and by selling call options of higher strike price, later on what they do is during the closing hour, go and exit at market price all the ICICI Bank and HDFC Bank shares what you had earlier bought, and thereby it will make market crash. Your put options premium will shoot up in a huge way, and also the call options what you sold, you will even benefit out of this. And see the data, it is very clear, Ankur. The total profits what these guys have made in last 2 years is about 36,500 crore. Out of this 36,500 crore made by Jane Street in last 2 years, 43,300 crore is the gain what they have made out of options. And in fact, they have lost 7,500 crore in futures trade. So they have lost 7,500 crore, made 43,300 crore, and they have definitely used this method as a secretive strategy, but there is no secret whatsoever. You have made it at the cost of retail retail people money, and you
Right.
have misused all the things which are available.
Definitely, and which is why SEBI is essentially trying to ensure a level playing field. But then, Sanjay, let me come to you. I also want to understand the grip in terms of tightening the algorithm or the complex trading strategies in India. How can we ensure, or how do you think SEBI is actually trying to create and ensure a level playing field and fill up the gaps that we are seeing in this particular case as well?
No, true. So that is a policy decision which the SEBI has to take, amend the regulation, tighten the regulation in order to see that such an event or similar events do not reoccur. This is, look, there are no, in that sense, allegations that they've done something which is not within the four corners of law. It is only that they have been intelligent and clever both in order to trade on the market. So therefore, if you see the order, of course, I've quickly gone through the order because it's a detailed order of 105 odd pages. But prima facie, my view is that, look, they've only been little clever and intelligent in order to trade on the market. But it's pure and simple on the preponderance of probability, which is the principle that SEBI has levied this, found out this, and have passed this order. But otherwise, they've not nothing illegal which they've done in order to get a slap of a huge penalty, in my view.
All right, I just want to draw attention, since the word was used illegal. I am just saying that what is there in the order which is mentioned by SEBI. Just want to draw your attention to page number 88, whereby SEBI has specified why this is unlawful. The order specifically says Regulation 4.2 deems any act to be manipulative or fraudulent if such kind of activity is made or misleading appearance of trading in securities market. In fact, I will just take one more para into consideration before I come for next question. 20th point clearly mentions that Bank Nifty index options expiry days identified with intraday index manipulation strategy in this order, and that is why SEBI has actually called it illegal in the interim order. But I want to come to you, Mr. Haribhakti. How do you see the legality of this order, which I'm sure will be questioned in other courts?
I must say that the way that the whole transaction has been described in the order gives rise, in my mind, to the clear conclusion that it was illegal, particularly because the regulation was amended to make sure that at the end of the market, if you put through massive quantum of transactions, that is going to be considered as illegal. And therefore, in my hump on which the impounding of 4,843 crores has been made, and this is not a penalty. This is an impounding of illegal gains. Penalty will be discussed and decided after the full investigation is over, and Jane Street has the chance to actually come back and make their own submissions. But it does seem like this is a highly manipulative, very, very egregious kind of behavior.
All right, Mr. Rudramurthy, I want to come to you again for the understanding perspective, because the total illegal gains are around 4,800 crore. But if you see the profit which has been made by the company, which is over 48,000 crore in the set period, I want to understand that how does this stand? On one hand, SEBI has now specified in detail in 16 pages that why this order needs to be passed and why this is actually illegal. But how does it work in real terms? How do you identify the gains which has been made in normal terms and this 4,800 crore which is illegal?
Ankur, point number one, even though I'm not a lawyer but a qualified chartered accountant, let me tell you, if you go back and see the case of Justice Rangnath Mishra, where he's clearly saying about similar instance of another case where you had colorable device, and it is most important to uphold the purpose and intention of law. Legally, you might have taken care of every word which law has told, but if you have not taken care of the intention and purpose of law, it is still considered as a colorable device, and that's what Jane Street has done here. I want to tell you, whatever order we have read through, even I have gone through that 105-page long order, it clearly mentions only on Bank Nifty, if this is the gain, you imagine even what they would have done with Nifty, or even for that matter, Sensex also. And whatever you call this a secretive strategy, or it is an intelligence over and above the normal market intelligence, the purpose of law is completely here gone. What they have done is they have just taken positions on one end, planned clearly only on mostly expiry day trade. Earlier, you had all the expiries happening on a day-to-day basis. Thanks to the regulator who later on told you may not have those daily expiries. They even took steps in order to increase the lot size. They even took the steps to increase the margin. The benefit what you were getting even because of the hedge positions in terms of margin payment for options also was changed. So regulator really took all the measures which were there. But I personally feel, I might be completely wrong, but my perspective individually is this is a colorable device. You have completely taken off the purpose or intent of law, even though you might have followed the words or the legality as such, but still you have defeated the purpose of law, and it is against the retail traders who are there in market. And yes, a caution to even retail traders. You
Right.
have to also understand making money in a quick way, taking high leverages, trading
Absolutely.
against these traders on expiry day is not suggested even for retail traders.
Absolutely. The risk factor is really high over there. But then having said that, Sanjay, I really want to understand from you now, how are global funds expected to navigate Indian regulations differently after this particular episode? Just an understanding, do you think India is becoming more difficult for high frequency or quant firms in this particular scenario to operate in stricter norms and regulations? How can we go about it from a macro point of view?
No, absolutely. It is definitely going to be difficult. And therefore, in order to develop a proper healthy market, there has to be a regulation which is a win-win situation both for the traders, both for the quant funds, as also satisfying the or protecting the retail investors, and at the same time following the law in letter and spirit both. So therefore, you do require a proper regulation in order to see that the quant traders and the quant funds are able to trade on the market. Two, it should develop a healthy stock exchange, because in my view, stock exchange is the barometer of an economy. And in case there is no healthy and progressive stock exchanges in the country, then obviously it affects the economic progress as well. So therefore, it's a mixed bag which when SEBI will have to bring out detailed regulations in order to see that such things do not occur. At the same time, if somebody is following the law to in letter as also partly in spirit, it should not be affecting adversely that particular trader in the market.
All right. Two important things which are mentioned in the order and has been mentioned repeatedly. One is the marking the close strategy, which means in simple terms, you actually hammer it out near the close in FNO, and that was the strategy which was allegedly adopted. And second one, example of Jan 17, just bringing out few facts once again. The Bank Nifty options versus total market was 98 times. Yes, 98 times, and that itself data is baffling. And how Bank Nifty was moving that day, how trades were occurring on that particular day, which has been identified by NSE and of course submitted to SEBI. But I want to come to you, Mr. Haribhakti. Do you think this instance is a reminder of larger overhaul, or you think this is a case where the law was not followed?
I think it's partly both. As Sanjay Bhai was making the case, we do need to have a very vibrant capital market, but we do need protection of people who can be trapped as they were. There was clear, huge buying, and their particular share of the trades was also 25%. if I recollect from the order, as compared to the next highest being hardly 8%. So clearly, it was a concerted strategy to make sure that the prices moved in a way that the profits could be made in one market while losses were being made in the other. And to my mind, this is really a sign of what my friend called a colorable device, and therefore not uh, within the parameters of the regulation or the law. And therefore, that is the direction in which the final SEBI investigation will move, and we must await the outcome of that. Of course, this interim order is so detailed, and most of the facts seem to have been garnered. So from interim to final, I don't see a very long time elapsing. So we won't have to wait too long before we see a final order.
All right, thank you so much, Mr. Sanjay Ashar, Shailesh Haribhakti, and Mr. Rudramurthy for joining at this hour. And with this, we have come to the close of this discussion. But SEBI has clearly identified strong legal reasons in the interim orders, but we need to wait and see what is the final order, if there are any legal complications that will continue to report. I just want to take your leave with that, and it's time to say goodbye. On behalf of Kavita, me and entire ET Now team, thank you for watching.